Today, we're going to talk about term insurance. Term insurance is usually where we start in terms of providing basic coverage for an individual or a client. And term insurance has also been referred from time to time as temporary insurance. And the reason why they actually call it temporary insurance is because there's an expiry date. In other words, this is a coverage not for the rest of your life, but in actual fact, it could be for 20 years, 30 years, or perhaps to an age 65 or an age 75, which is the most popular one. But essentially what happens here is that should you pass away during that term period, you're covered. It's not a problem. However, it will expire. So at the end of that expiry date, should you pass away after that expiry date, there's nothing there's no coverage at all. Also, there's no residual benefit. In other words, there's no cash value, nothing. So essentially, term insurance, you might say it's almost like car insurance on your body. Should you die during a term period, you'll pay, and should you die after that period, then you won't pay. And of course, there's no cash value. There are 4 different kinds of term insurance products that are sitting out there today. The first one is level insurance. With level coverage, basically what you've got is the coverage remains the same. So, for example, let's say you had $500,000 worth of coverage. The $500,000 will continue on for the entire period, whatever that may be, 30 years, 40 years, whatever. It will always be $500,000. And the premium will also remain the same as well. So you've got basically the individual knows exactly how much coverage they've got, and they also know exactly what the premium is going to be for that entire period of time. And it's fully guaranteed, no questions asked, that sort of thing. The second product is what we call decreasing term. And this is really more like your typical mortgage insurance, in that the coverage actually decreases year by year according to your mortgage or whatever the loan happens to be. So essentially, decreasing term decreases year by year for, let's say, 25 years or whatever. However, the premium remains the same. So here we've got a decreasing amount of coverage. So the insurance company has less and less risk as the years go on, but your premium actually remains the same. So most of you will probably recognize that as mortgage insurance. The last one, the second last one, is increasing term insurance. This is the exact opposite, of course, to decreasing, in that this is really for the individual saying, I'm concerned about purchasing power. I know that $500,000 today buys $500,000 worth of goods. But 10 years from now, at a certain rate of inflation and everything else, you may only buy $400,000 worth of goods. So how can I protect myself against the erosion, basically, of purchasing power and everything? And so you buy an increasing term policy. When you're doing an increasing policy, what happens is, of course, it will increase according, for example, to the consumer price index. It could be an actual number that you chose, 2%, 3%, things of that nature there, okay? But also, things you have to make sure that your client is aware about this increasing term, as much as it looks nice and it feels nice and everything, is that the premium will also increase accordingly as well. So here we've got basically, we don't have that level coverage and we don't have that level premium. We've got an increasing amount of coverage, and we also have an increasing amount of premium as well. So you need to make sure your client is aware of those issues. Probably the most popular of the level term product is what we call renewable and convertible term insurance. So it's renewable in that every period it renews automatically, okay, and it's also convertible. So let's look at the renewable first. The most popular one is 10-year renewable. So really what happens, we're saying, is that during the 10-year period of time, for example, $500,000, you're insured for $500 a year, let's say, for $500,000 worth of coverage. 10 years from now, the price will go up to, let's say, $700 or $800, whatever. 10 years from then, the price will go up again. So this is very, very popular because the coverage does remain the same. It's that same $500,000, so it's very similar to this. Except that in this one here, if you recall, the premium was going to be much higher, but it'll be the same all the way through. So to make it more affordable to the clients and everything else, the industry has created a renewable product, which basically the premium starts off considerably lower on the first 10 years, let's say, then 10 years later, it goes back up again, and so on and so forth, all the way through, so every 10 years. So it is 5-year renewable, 10-year renewable, 20-year renewable, depends on what the client's needs is. But the important thing is that when it renews, okay, there are 2 things that have to be considered. Number one is that most of them will have what's called a guaranteed amounts. In other words, the worst case scenario is in the 10th year, this is what you're going to pay. And it's already stipulated in the contract and everything, so there's no misunderstanding about what's there, what's not there, what it's going to cost and everything. It's all right there. Okay? So it's guaranteed no matter what happens at the end of 10 years, the end of 20 years, whatever, this is the price you pay. However, a lot of companies today also have a lower rate, what they call a re-entry rate. So, for example, 10 years from now, you subject yourself to medicals and so on, and the insurance company sort of basically re-underwrites the case, and they discover in actual fact that you're doing very, very well, you're very healthy, taking good care of yourself, you're not smoking, you're not, basically destroying your body, you might say, then they may actually offer you a lower rate. So the guaranteed rate is there, okay? So you know that that's the worst case scenario, okay? However, we also, if you are prepared to give us the medical evidence and everything, in other words, re-enter, then we are prepared to maybe consider the possibility that you will have a lower rate. And so once that lower rate is established, then let's say for the next 10 years, that you pay that lower rate. 10 years down the line, we do the whole process all over again. Okay. So our worst thing is that the guarantee is the worst thing that's going to happen. The rest of it, basically, it's going to be up to you and how well you take care of yourself and everything. And that's about all you really need to know about term insurance at this point. So we will see you next time.